Welcome to the deep dive. Today we're digging into Ross Stores, their Q2 results, and what they're saying for the rest of 25. So let's jump right in. Ross Stores Q2 2025, the big headline. Earnings per share, $1.56. That actually beat the forecast, which was $1.53. So a solid beat there.
Yeah, it is. And what's kind of fascinating here is while EPS beat, revenues didn't quite get there. It came in just slightly under $5.53 billion against a $5.54 billion forecast.
Interesting. So hitting profit targets even with a tiny miss on the top line.
Exactly. It suggests, maybe really tight cost control, or perhaps that shoppers are just laser focused on value driving that bottom line. It shows some operational skill.
And how did the market take it? The stock dipped slightly.
Just a bit, yeah. Down 0.5% in regular trading, but then it actually gained a little, 0.38% after hours. So maybe cautious at first, then a bit more optimistic once people process the profit numbers.
Okay. And connecting this to the bigger picture, what about margins?
Well, that's where you see some pressure. Operating margin decreased by 95 basis points.
Wow, almost a full percentage point, down to 11.5%.
Right. And a key driver there was tariff-related costs. They estimated about an 11 cents per share negative impact just from that.
Okay, so tariffs are definitely a key theme here.
Absolutely. And we'll see it again when we look at their guidance.
But despite that pressure, sales still grew.
They did. Total sales were up a solid 5% to $5.5 billion. And comparable store sales, that's growth in existing stores, were up 2%.
So what's driving that underlying growth? Any specific areas?
Yeah, they called out cosmetics and ladies' apparel as being particularly strong performers. Geographically, the Southeast and Midwest did well too, which, leads you to wonder how they keep that momentum going.
Well, part of it seems to be expansion. They opened, 31 new stores in Q2?
Uh-huh. And the plan is for around 90 new stores this whole year. They're even pushing into new markets like the New York metro area and Puerto Rico.
Interesting. So they're not shying away from competitive areas. Shows confidence in that off-price model.
Definitely. It's a clear part of their strategy.
Okay, so that's Q2 kind of resilient performance, but with those tariff headwinds. What about the road ahead? The rest of 2025?
Right. The forward guidance is really crucial. For Q3, they're projecting EPS between $1.31 and $1.37. And for Q4, it's $1.74 to $1.81.
And you mentioned tariffs impacting guidance too.
Yes, explicitly. They expect tariffs to cost about 0.7 to 8 cents per share in Q3, and then another $1.04 to $1.06 in Q4. So they're being transparent about that ongoing hit.
So putting it all together, what does the full year look like?
Full-year EPS guidance is set between $6.08 and $6.21. Now, that is slightly below last year, but it directly reflects that total expected tariff impact, around $1.22 is 25 cents per share for the year.
And sales growth expectations.
They're planning for 2% to 3% growth in comparable store sales. They describe their overall stance as a somewhat cautious approach, given the general economic climate.
Right, but didn't the CEO, Jim Conroy, sound pretty bullish on the off-price model itself?
He did. He really emphasized that historically, disruption in retail tends to benefit off-price players, and he believes this time won't be any different.
So how do they plan to offset those specific tariff costs then?
It's a few things. Aggressive vendor negotiations, trying to get better deals. Also, diversifying their sourcing, moving away from places with high tariffs where possible, and some strategic pricing adjustments. They kind of expect prices might rise across retail generally.
So if everyone else's prices go up, Ross's value looks even better.
That seems to be the thinking. It could actually strengthen their position with value-conscious shoppers like you.
Okay, so let's wrap this deep dive up. Ross stores in Q2 showed, resilience, a solid earnings beat despite a slight revenue miss.
With those tariffs definitely playing a role, but seemingly managed.
Right. And their guidance for the rest of the year is cautious but strategic. They're leaning into what they do best, off-price, and expanding their footprint.
Which leaves us and you with an interesting question to ponder. If we do see broader price increases across the retail landscape, how much more market share can off-price retailers like Ross actually grab? And what does that ultimately mean for you, the consumer, looking for value?